Hey, David Zai Mortgage Guy here. If you've ever considered buying a home but feared confusing loan processes and expensive down payments, you're actually in the right place. Thousands and thousands of first-time home buyers are turning to manufactured and mobile homes as their first step on a journey to financial freedom. I personally helped hundreds of people just like you secure a manufactured home and go on to turn that into real wealth for them and their families. So, today, I'm going to actually walk you through the process from start to finish, share some of my personal experiences along the way, and by the end of this video, you'll actually be ready to shake off the shackles of renting and find the freedom and ownership with a manufactured home. Ready? Let's get started. 2024, and currently we are actually in a low inventory market, otherwise known as a seller's market. This has caused home prices to skyrocket over the past few years, which is good if you own a home, but for millions, this has really made it seem like homeownership is a long-lost dream. But this is far from the truth. Manufactured and mobile homes are truly a lifeline for those pursuing home ownership. So let's talk about the benefits of manufactured and mobile homes. Number one is going to be the affordability. The affordability of these homes is, second to none, really. You get a real good quality roof over your head, and sometimes they're built a little better. However, with that affordability versus a stick-built home, it's truly like 2 to 3 times more to get a stick-built home over a manufactured home. The second thing that people don't know about is that there is customization, just like that stick-built home that you can have. So you can customize the kitchen, you can customize the bathrooms, you can customize the type of floors you have, you can even customize the skirting that goes around the house. And then finally, I think a really big benefit is the faster move-in time. Because these homes are built in factories and put together in factories, there's higher quality control when it comes to building the home. It goes off through the assembly line. There's many eyes looking at each part, from the A-frame to the frames and the trusses that hold up the walls and the ceilings and everything else. It's just a faster move time because everything goes from factory to site. Now, let's talk about how to understand manufactured home. Manufactured, which is built in a factory and it's stick built, and then there's mobile homes, which is something that's also built in a factory. However, it is transported to the site on wheels and axles. There are HUD codes and quality standards that are involved in these. Any home that was built after 1976 is going to have the quality control of HUD saying, hey, these are the standards that this manufactured or mobile home has to have. On the HUD codes and quality standards, we're actually going into detail about this further down in the video. And then finally, let's address the common misconceptions. The misconceptions are huge. There's depreciation. Hey, this is a mobile or manufactured home, so it's not going to be worth as much for as long. That's absolutely false. Now that these standards and codes and quality standards are in place, the mobile homes are definitely retaining value. And same thing with the manufactured homes, which are stick-built, right? The stick-built homes, especially the modulars, are built to such a high quality standard that truly it doesn't depreciate, it's going to appreciate. With that being said, we're going to start talking about financing your manufactured home now. So let's now explore the different loan options. The loan options that are standard are going to be your FHA, conventional, VA, and USDA. We'll go over those guidelines down below. However, if you find a property that is not financeable by those types of loans, we also offer some non-conforming options that will be able to help you finance some of these loans. Now, when buying a primary residence, it's truly important to know how much you have to put down on each option. And when it comes to Fannie Mae or Freddie Mac, which is conventional financing, it's a 95% LTV. So you have to have 5% down on these loans. On FHA, it's going to be the standard of 96.5, which is 3.5% down. And then on VAs and USDAs, those are actually offered at 100% loan to value, so no money down on those. Now, if you're buying this manufactured home or modular or mobile home for a second home, the loan to value on those for conventionals, they're going to start out at 10% down or 90% loan to value. However, it's really important to understand the loan level pricing adjustments when you're getting a conventional loan. What are loan level pricing adjustments? Loan level pricing adjustments are basically like a chart that says how much you're going to put down and what credit score. And based on those numbers, it's going to say how much of an adjustment in terms of discount points you have to pay upfront, and that's upfront interest to get that certain interest rate. It's really important to understand this and work hand in hand with your loan officer when picking your loan options. When it comes to purchasing the manufactured home, it's really important to also understand that the home and land has to be purchased simultaneously on one purchase agreement. Whether you're buying it from someone that's selling the property that they currently live in, whether you're buying it from a dealership, or whether you're buying it from the site itself. When you're buying this, You have to know, in order to qualify for this conforming, which is VA, FHA, conventional, and USDA financing, you have to purchase the land and the home simultaneously. Borrowers cannot purchase a home for land that they've already owned. So USDA purchase loans must be the purchase of a new manufactured home. Borrowers must be purchasing the home from a dealer, and the manufacture date must be within 12 months of the purchase agreement contract. On an existing manufactured home, the home must currently be financed with a current USDA loan or meet the requirements of the pilot program built on or after January 1st, 2006 and is located in one of the eligible states. The states included in the pilot program are Colorado, Iowa, Louisiana, Michigan, Mississippi, Montana, Nevada, New Hampshire, New York, North Dakota, Ohio, Oregon, Pennsylvania, South Dakota, Tennessee, Texas, Utah, Vermont, Virginia, Washington, West Virginia, Wisconsin, and Wyoming. Wow, that was a mouthful. So that's nearly half the country. So if you live in one of these states, give our team a call and we can get you started on your USDA loan as soon as possible. Now that we've kind of gone over all these loans and you just don't know which loan is best for your situation, it is important for you to compare loan requirements, interest rates, and down payment options. For example, a couple with a strong credit score could certainly qualify for a conventional loan with a higher interest rate and a smaller down payment compared to FHA loans. This could actually save you money in the long run, especially if the conventional PMI is lower than the combination of FHA's upfront and monthly mortgage insurance combined. Conventional loans will actually give you the option to choose one mortgage insurance factor or PMI factor, such as a monthly factor, a single factor, split, whereas FHA will actually require you to finance upfront mortgage insurance premium, MIP, which is 1.75 upfront financed into the loan and 0.55 of the loan amount monthly with less than 5% down. If you get a 30-year FHA loan and put 3.5% down, you'll actually be paying for mortgage insurance premium for the entire term of the loan or as long as you have the loan. If you put down at least 10%, you'll actually be paying for the mortgage insurance premium only 11 years. Whereas for PMI on a conventional loan, it actually goes away after you get to 78% loan to value, which is 22% equity. So now that we understand how these loans work, we really have to go into the document gathering stage. It's really important that you gather all of your documents up front before you go under contract, because the underwriter and the loan officer and the processor really have to know what they're working with up front. The reason I'm bringing the processor and underwriter into this is if the credit score is on the lower end of where the FICO approval would be, then we're probably going to want to have your file completely reviewed. So the necessary paperwork that you have to gather for a true pre-approval are going to be your income, your assets, and your liabilities. In terms of income, we're really looking for tax returns, pay stubs, W-2s, or 1099s, any award letters for any type of fixed income such as Social Security, retirement, or pension. Then we're looking at assets, right? Assets are going to be your bank accounts. They're going to be your stocks, bonds, mutual funds, 401ks, TSPs, and any other liabilities or assets. And then in terms of the liabilities, we're looking at things that are not on your credit report. Any alimony, maintenance, or childcare, child support, anything that is going out that doesn't show up on your credit report, however, you have some sort of documentation on it. Certain loans do require us to count childcare, such as the VA loan for residual income, and then other loans like the conventionals and FHAs don't require us to use that at all. Typically, the biggest delay when it comes to getting your loan processed, that means you've gone under contract and you're going through the process. When you have a lot of conditions, and this is why I don't look at reviews sometimes when it comes to mortgage companies and loan officers that we bring on to work with us, because ultimately it takes two to tango, right? And we've all been down the process. If you're a loan officer, you ask your customer for 5 documents and then you get 3 documents. At that point, the delay in loan processing is truly due to missing documents. It's really important that you are working with your lender to understand the required documents, because documents are truly going to be specific to you. Everyone's not going to have the same exact documents, and truly all the documents that I rattled off, probably only 20% of those are going to be applicable to you. So now that you've gathered your document, let's talk money, down payment, and closing costs. Things to truly consider are, what is the minimum down payment versus the ideal down payment? And a lot of this is going to really be based on your budget and the different loan types. We've talked about the mortgage insurance factors. So if you're truly seeking like the lowest possible payment, you really need to talk to your loan officer about different ways to work with the private mortgage insurance if you're going conventional. So instead of paying monthly mortgage insurance, maybe you can do upfront premium and buy yourself out. In a higher rate environment, I truly don't recommend that. I would truly just go with whatever the minimum is and then look for that opportunity to refinance. And at that point, that's when I go all in with my chips and buy down that interest rate if you know you're going to be living in the home for a long time. If money is a concern, like how much you can put into it, at that point, I would talk to your loan officer about, hey, what is the lowest down payment option? And is there down payment assistance or grants or any types of programs out there that could help us out? So right now, we have on conventional loans for first-time home buyers, certain home buyers that are buying in certain areas and meet income limits can qualify for certain grants that are actually forgivable at closing. When you're talking to your loan officer and you're trying to weigh out the different options from down payment versus monthly payment, this is truly something that you need to work on. There's always going to be difficulty working on that larger down payment for a lower monthly mortgage payment. Before going into buying a home, it's really important to game plan for that money. Write a contract and say, hey, I'm going to start saving money throughout the process. That's truly not the most efficient way of doing it. You're really forcing yourself to do something. If you have the time and you know you're watching this video and it's going to be 1 to 2 years before you actually end up buying, I think you need to start budgeting. And the best way to truly budget is to start taking a portion of your pay out of your account and actually sticking it into something that you cannot access, okay? So that would be always invest in your retirement plan, because if you're buying your first home, you could actually use that for a down payment, whether it be a loan or a one-time deduction, or putting it into a high-yield savings account or CD, because if you take that money out, you're not going to be gaining the high yield, and if you take the money out of the CD, you will be penalized. Let's kind of explore some low down payment and different programs and assistance programs that are out there. So USDA is the greatest example, right? USDA, yes, there is a rural restriction, so you have to put the address in through USDA, and then there's also a income restriction based on your household size and the composition of your family. However, with USDA, it does offer no money down for the purchasing of the house. And here's the real good thing about USDA if we go this route. If the USDA appraisal actually comes in higher than the purchase price, let's just say you have a contract to purchase the home at $200,000 and it comes back in at $210,000. You can actually take the difference between the $200,000 and the $210,000, that $10,000 difference, and you can actually use that to apply towards your closing cost. So there's another added benefit. I recently worked with a customer. He had some money saved up, 20% down for a conventional loan. And with that, we weighed everything out. It was like, okay, do we take the 20% down and eliminate all the PMI and get a payment? Or should we actually take some of this money and pay down debt, have less money down, so going into the house, his overall debt to income ratio came in lower? We actually opted for option 2. So instead of putting 20% down and having the lowest possible mortgage payment, we actually took 15% and used that to pay off debts. And with that elimination of $1,000 a month in consumer debts, the overall debt load that he had and the blended interest rate between all the credit cards, loans, and the mortgage was actually lower than getting the 20% down conventional. So always work with your loan officer. When I work with a customer, I always tell them we're truly married. You have to share everything that's financial going on, any questions or concerns that you have, almost like my spouse and I talk about every single night when the kids are asleep, right? This is the time that we start talking about the kids. The pre-approval process is very strenuous. However, getting pre-approved before house hunting is going to be really important because number one, it helps you determine your budget. Having that budget is super important, right? You know, you could say, yes, I want to buy a $300,000 house, but if you don't know what that monthly payment is and how it affects your budget, it's really going to be a bad situation in the long term for your financial goals. However, if you have determined, yes, this is in my budget and you get pre-approved, this actually shows the seller that you're really serious about buying a home. And it shows the listing agent that, hey, if I'm comparing offers and I'm looking at a pre-approval letter versus a pre-qualification letter, I'm probably going to want to go with a pre-approval letter because that loan officer has actually reviewed all the documents. They know all the income, assets, and liabilities. Whereas the pre-qualification letter is just, you've talked to the loan officer, you haven't sent in all your documents, and they're just taking all the information that you've given them verbally and saying, yes, you qualify. One of the things that really hurt the most, especially in this competitive market, is getting outbid on manufactured homes because your offer is contingent on loan approval. Now, what's one way that you can kind of get around all this? Because this is 2024, and with that, the market is a seller's market, right? So there's very limited inventory. Anyone that is selling is actually giving up their lower interest rate to go to a higher interest rate. So when they're taking offers, they want to make sure that they're getting an offer that's going to close right away. Before you make an offer that is contingent, it's really important to show the seller how qualified you are, right? So a couple strategies that I would use is this. Before you make the offer, get your house that you're selling under contract. Number 2, work with a very reputable lender that can go to the listing agent and say, hey, listing agent, I've qualified the borrower. I've been in the business for X amount of years. Here's my NMLS number. I'm a top producer when it comes to this, and show the stats, because really, talk is cheap. What's shown in writing, like your stat line, when you're looking at drafting for your fantasy football draft, you're not going to say, oh yeah, I like that guy because he talks a lot on the news. No, I'm looking at the stats. How many games do they play? How many yards are they getting? How many catches? How many touchdowns, et cetera, et cetera. So you should really treat your home buying process just like that. Contacting a lender that specializes in manufactured housing or the specific types of loans that you want is also very important. Not all lenders are going to be the same, right? Certain lenders are going to be retail, certain lenders are going to be wholesale. Certain lenders only offer certain products, and then other lenders, such as myself, we have multiple investors, 220 different investors. That's a lot of money that my company pays to get approved with these investors. However, because of that, we're able to give you different options that give you the best in terms of product, best in pricing, and the best in speed. Let's go ahead and talk about a customer that I helped out recently, okay? This is Crystal. In order to make our offer strong, they had a contingency. We're still kind of working through their process right now. So Crystal was selling her house that she financed with me 4 years ago. She's gonna make some significant money from the sale of that house. And because of that, that's actually gonna help them pay off a lot of debt. The reason that they are wanting to move is they want more land, and they've identified a manufactured home that truly fits their needs. This is a double wide, and there's a huge barn in the backyard. Crystal's idea of all of this is like, yes, I am increasing my monthly payment. However, one way that I can really look at this is my family and I, we're going to be able to enjoy a larger lot. We have more square footage now because we're going from 1,100 square foot house to a 2,000 square foot double wide. There's more land. So they're able to homestead, raise some chickens, raise some other animals, and they can get eggs and everything that homesteaders want to do. And the barn, her idea is to actually turn that into a barn-dominium. Now, what is a barn-dominium? The reason she wants to do this is it's going to actually generate additional income for her. So she can use it as a spot for photo shoots. She can use it as a spot where people can go and live in it as a short-term rental. And then finally, she's now creating that extra space that can actually be rented out long-term if she wanted to. So she's actually given herself a lot of different opportunities to monetize on the barn, as well as save money on food and other things by homesteading. So now that you're pre-approved, let's go down the journey of finding your dream manufactured home. First step that we have to take is we have to set your budget. We have to know what the budget is before you buy. Know your payment, the principal, interest, taxes, and insurance, make sure it's all included. How rate and down payment kind of affect your payments is really going to be a big key in your budgeting. So what do we need to do, and what do you need to know about your cost? So let's talk about the upfront cost. The upfront costs are going to be this. There's going to be an earnest money deposit that you have to put down to say, hey, I'm very interested in your house. I'm serious. And this is basically going to be deposit that says, if I don't follow through with the full loan and I just walk away and I'm qualified, I lose it, right? I can be sued. So that earnest money deposit is really instrumental in putting down, and the larger the amount, the higher your intent to want the house. The next thing is we have to budget for the appraisal. Appraisal is basically a person's observation of the house in terms of safety, sanitary, and structural. And the appraiser actually looks in a radius of where you're purchasing the house and says, hey, other houses of the same composition, the same size are worth this, okay? If there's any safety, sanitary, or structural concerns, these are the repairs that need to be done in order for us to get this value. And then finally, the third upfront cost would be the credit fee or credit report, right? Credit reports have increased a lot in 2024. That's definitely something that you should budget for. And I would say you should probably budget between $100 or $60 and $150 for the credit report. During the actual transaction, the upfront would be, hey, before we get the contract, now that we've gotten your contract accepted, what do we need to budget for now? We have to budget for a home inspection. A home inspection is an optional thing. However, with the home inspection, they will actually go into the house, inspect it from basically head to toe and say, hey, these are the issues that I find wrong with the house and you should negotiate these repairs. Home inspectors do not have to be licensed, but I would look at Google reviews. I would look for a national company because those national companies actually have really good training and they have really good insurance just in case they miss something. So it's really important to get that home inspection. Next thing would be totally optional on most loans except for VA loans, and that's the pest inspection. Pest inspection, we should probably budget anywhere between, I would say, $100 and $300 for the pest inspection. And this is all going to be based on the size of your house. However, depending on where you live, there's going to be different types of pest, right? I live in Virginia, and in Virginia, as close to the water as I am, it's not if you're going to get termites, it's when you're going to get termites. So it's best to be precautious and know your environment, know your settings, and budget for that pest inspection during the home inspection and budget for the termite bond after the closing. Next thing would be survey. This is totally optional, but it's really nice to know what land you're actually purchasing, right? Having that survey in place will solve any property disputes in the future. And this truly is optional on most loans unless the appraiser calls that, hey, we may need to get a survey because right now, while I'm out here, I'm looking at this is where the property line starts and this is where their fence is. So your fence may actually be in someone's yard, and if your neighbor doesn't like you, they may make you take it down, and that could be a very, very costly expense. Closing cost and down payment are probably going to be lumped into the final things that you have to budget for during the transaction. You've proven to your loan officer that you have the money up front. Let's just say the interest rates went up. You need a little more money to qualify. So you can't get the closing costs from the seller. At this point, you have to have that contingency plan, right? A gift. Am I going to dig into my retirement plan? Where am I going to get this money from? And then finally, after the transaction closes, what do we need a budget for? We need a budget for any contingency reserve or any minor and major repairs. How can we offset this contingency? Should we take some of this contingency money and maybe apply it towards like a home warranty that covers all of your major systems? Or should we take some of it and also put it into your insurance cost? Having that insurance cost and having that additional coverage is very important. A customer that I recently helped, she lives in a house and it's made of stucco or ephes. During one of her times of hanging up a picture, she started hammering the wall. Well, she popped a hole into the wall. When her husband went to go repair it, he looked in and he's like, hey, this is why it happened. There's a lot of moisture behind the walls. And the further they inspected, the more they cut out, the more they noticed that everything under the walls, under the stucco, was all bad. The house had to be rebuilt. So in situations like this, hidden costs like these are truly stressful and impossible to predict and really get out of hand fast. So expect the unexpected. Let's talk about where we're going to look. You have to explore various channels to find the manufactured homes. Sometimes it could be online listings from different real estate websites. Sometimes it could be MLS search that your realtor sets you up with. Manufactured home communities are a really good place to look. And then finally, if you want something new, the dealerships would be a great place to look. Now let's go back into understanding that inspection, right? The home inspection that we talked about, that upfront cost. And this is why it's really important. When you get that professional home inspection on a manufactured home, even if it's a new construction, like a brand new manufactured home that was rolled onto the site, whether it's a mobile home that's rolled on or a stick-built like modular home, it's truly important to get that home inspection before the process and after the process. The reason I say that is when you inspect it beforehand, you could really catch like, hey, you know what? I don't like the way that that's put together or this or that. They can make corrections and modifications at that time in the factory. If you go look at it afterwards, yes, everything may look great to your eye. However, having that trained eye to do that inspection is really important. Let's kind of circle back to my customer's home, right? How did they get this remediated? It's really important to understand this. During the process, and I'll tell you, I've gone down this road multiple times. If you don't know the composition of the home, you didn't pay attention to the home inspection or even that appraisal report, I will tell you, when buying a home that has unique characteristics like that stucco or the ephes, my customer made the right decision. She could have went really inexpensive and probably went with the first insurance plan that was offered. And if you know insurance like I do, like half of the insurance company will go out there and inspect the property and say, oh yeah, this is wrong. This was written down wrong when the quote was provided. And it actually should be this much higher. So in my customer's case, when you buy a house that is stucco or ephes, those costs for homeowners insurance are typically double. Luckily for my customer, she did not skimp out on this, okay? She said, look, I'm gonna pay that double because I know this could be an issue. We're in a waterfront house. In the end, this house had to be torn down, basically down to the foundation. However, the insurance company covered it with a deductible of just $3,000. Because of my customer's careful budgeting, she turned what could have been a $500,000 bill into a $3,000 deductible. Not even 1% of the cost of a new build. Now that we've built our budget, it's time to make an offer that they can't refuse.
I'm gonna make them an offer they can't refuse.
Research the average sales prices. Data's available all over the internet now. Target communities that you want to live in. When I knew that I wanted to buy a home in the community that I live in, I'll tell you, every weekend we spent time driving through that neighborhood, okay? We were scouring the MLS, we were scouring the online websites, we were scouring every for sale by owner website. Once we kind of identified that community, we were like, okay, we need to make a competitive offer. My kids' school basically counted on this. We considered all the loan program restrictions. Conventionals basically allow primary and secondary residences. USDAs require purchases of new homes. Now, the pain point is like losing out on this manufactured home may require you to wait even longer in a competitive market to find something that you love. So my rule of thumb is always, when you find that house that you truly love, it's okay to make an offer on it, even if you're not 100% convinced. Because during that home inspection, that's really your get out of jail card, right? During the home inspection, you get a real thorough look at the property. The home inspector says, okay, these are the issues that are wrong. And even if it's something as simple as like, hey, I don't like the fact that that outlet in the kitchen doesn't work, that is acceptable reason to back out of your contract. Work with your realtor, if you have one, to kind of craft that like strong offer. Make sure you understand the comps. Make sure you understand the market conditions that you're in. Make sure you understand if sellers are paying for closing costs, and don't just take their word for it. There are actually stats in the local MLS that can help you with this. And always take into consideration the home's condition, market value, and your loan program limitations. And after you've researched all of the comparables or comps, submit a very competitive offer on that home that you like. And having that pre-approval up front will offer not only peace of mind for the seller, but you can then have like a say in your closing date and make it a little more flexible if you have the strongest offer. So now that you've worked with your realtor and researching comps and submitted that competitive offer on your dream manufactured home, it's really important to understand your pre-approval status and what you have to provide the lender. When your lender has run the automated underwriting system, in that automated underwriting findings, it actually gives you all of the documents that you need. And based on that information that you have, that will hopefully help you determine a good closing date for you to make your offer more attractive. So if you can gather the documents up front and provide it to your lender, then you know that, hey, we can order the appraisal right away, we can order the title work right away, and we can have a faster closing, and that will 100% make your offer way more enticing. Now, I want to commend you. Congratulations. You've truly made it this far in this video, and you've made your first offer on your home. It's taken a lot of work, but we're here. At this point, you should feel confident in your ability to find your home, find your loan, plan and budget, and make your first offer. Let's talk about closing on your home and some important numbers you need to know before you go. Even if your loan officer says to you, the loan is completed, it may not be completed. So don't throw away any additional documents such as bank statements and or pay stubs or updated W-2s, because if there's any delay in closing, the underwriter may have to reopen your file again, even if you get a clear to close, because documents have been expired. And at that point, they may be asking you for additional paperwork. Or an underwriter may have missed some paperwork. Like recently, I had a loan that came back to me. We closed it 4 months ago and closing went fine. Everything was good. Everyone's happy. However, the borrower missed their payments. And when the VA actually went and investigated that loan, they said, hey, underwriter, because of the manual underwrite, you actually missed verifying the rent, which is mortgage 101. And now we're having to go back to the customer and ask for that additional paperwork. It's going to be harder. Okay. So always keep that paperwork handy and respond to your lender promptly to provide any documents needed to get a final clear to close again. So here's something to really keep in mind. Even if you have a clear to close, if there are any delays due to a walkthrough or the seller's not ready to close, and typically we don't discover these delays until pretty close to the closing date, it's important that you're constantly maintaining contact with your lender. It's important that you're constantly keeping all of your documents in line, even if you don't think that you need them anymore, because we've seen delays as long as 6 months, even a year. And with those delays, it comes with a couple different things, right? It comes with additional documents needed because they're expired. It comes with having to think about, hey, what is my cash to close now because my rate lock has expired? Do we go back to the seller and ask for more cost? These are truly delays that happen on, I would say 20 or 30% of the loans. But if you're in that 20 or 30% minority, it can be very stressful. So when the lender asks you for documents, respond promptly to the lender's request and ensure that all documents are accurate and complete. So I'll give you an example of a loan that I recently closed. Sarah was a customer that I worked with for a long time to get her where she needed to be. And when we actually went through the process, because she was very diligent at getting me the documents and everything, she provided me everything. And I'm telling you, this loan was one of the loans that typically people say, oh yeah, there's no way you can get it closed in less than 21 days. Well, in reality, we got it clear to close in 12 days. Because of everything that was prepared up front, the work of the realtor scheduling that home inspection right away, giving me the ability to order the appraisal right away. And because of that, we were able to get this loan clear to close in 12 days to ensure a smooth closing, on her home. So with every manufactured home, there are definitely specific requirements that are specific to the different programs. So you have to be aware of the program-specific eligibility. If you're in one of those states that doesn't allow the pilot program, then you got to know that. You can transition off a USDA into a conventional or FHA carefully. Most of the time, when you're working with an unseasoned loan officer, those loan officers will have higher loan application denial rates due to the ineligibility of a manufactured home itself. So when picking that loan officer, you have to pick someone that's truly seasoned, has the different programs, and has the options to be able to transition from one investor to another if any overlays of guidelines come up. Now, let's talk about the eligibility of the homes with the different guidelines. The basic eligibility is homes cannot have been previously installed at any other site or location, then relocated to the subject property. The only exception is if it was actually a home manufacturer or a dealer's lot as a new unit. Homes that are built on or after June 15, 1976 are within the HUD guidelines and standards. The appraisal form that is required is a form 1004C, so it's totally different from a standard appraisal. The type of insurance that you need on a manufactured home can be an HO7. The basic insurance coverages are a HO6. An engineering certificate from an engineering inspection is required on all FHA manufactured homes. The subject property on an FHA manufactured home cannot be in a flood zone. The flood zone is typically found on a flood certification that we order up front, or the appraiser has identified it as being in a flood zone based on their appraisal report. But the biggest tip is to ensure that the manufactured home meets the minimum standards for your chosen loan program, i.e. the HUD data plate, age, size, and etc. However, it's really important to work with your loan officer to understand all of the requirements of the program. So all loan types, conventional, VA, FHA, and USDA, require that the manufactured home has the HUD data plate and the HUD certification labels. Let's talk about the home size requirement now. The home size requirement for manufactured homes are determined by the type of underwriting system that we use. If we go conventional and we use desktop underwriting, it actually requires a minimum of 12 feet wide and at least 400 square feet. However, if we're going to go with a conventional loan that's through Freddie Mac, it actually requires the home to be at least 12 feet wide and at least 600 square feet. On FHA, VA, and USDA, the minimum square footage is 400 square feet, and on VA multi-wide properties, the minimum square footage is going to be 700 square feet. On average, a single wide is going to be between 14 and 18 feet long, 500 to 1,500 square feet, and I would say the average cost of those are going to be between $60,000 and $90,000. On a double wide, it's going to be about 20 to 36 feet long, and it's going to actually give you about 1,500 to 2,500 in square foot. So the average cost of a double wide mobile home is going to be between $120,000 and $160,000. On a triple wide mobile home, that can be 28 to 54 feet, and the ranges of square footage is going to be between 2,000 and 3,600, and the average cost of these are going to be between $200,000 and over $250,000. So let's now understand the actual everything all in when you're buying a mobile home or a manufactured home. So let's just say we're looking at a double wide unit. The double wide unit is going to be up to $150,000. At that point, you have to account for the delivery fee, which is going to be up to $10,000. And then we're looking at site prep, right? That includes pouring a permanent foundation. And that could be actually up to about $50,000. Now we're looking at installing a well and septic system. And the last time I had one done, which was about a year ago, it cost me about $25,000. Depending on the size of the septic tank, that could actually even go up even higher. Running the electricity is actually going to be the next cost that's associated, and that can truly be up to about, $15,000. Permits, impact fees, and tax assessments can be over $35,000. And then really when you add everything together, the total average install cost can range anywhere from $150,000 for this double wide all the way up to $300,000. So let's talk about some additional considerations that we have into now. Do we want to own the land that's underneath the house? That's truly something that I recommend because you own it. You call the shots on it. You can do whatever you want in that land. Or do you want to lease the land? Always weigh the pros and cons of leasing versus owning before purchasing that manufactured home, because really choosing the wrong option that doesn't fit you in the long-term goals could have significant financial impact. Research the average land lease fees and restrictions in your area. Consider the potentials for any appreciation if you own the land. And if you decide to purchase a manufactured home in a community with desirable land lease agreements, this option can truly provide you with a predictable monthly cost, access to community amenities. If you own the land, then you have the ability to do whatever you choose as long as you are not in an association. However, you will need to create your own amenities, but you get to enjoy the freedom and the benefit if the land value goes up. So now let's talk about property taxes and insurance. Whenever you have a mortgage, it should be factored into your monthly mortgage payment, PITI. However, if you have any association fees, that is going to be separate from the housing monthly cost. So that is something that has to be paid separate, and that's something that you have to budget for. Always have a reserve for any unexpected expenses from escrow increasing at the end of the year, because that can truly benefit or impact your budget. I recently had a customer reach out to me. They were like, hey David, why did my mortgage payment go up $400 a month? Well, the reason is at the end of the year, when the county went back through and reassessed that value of the property, they actually increased it. In addition to the increase of the value, the county's tax rate actually increased as well, along with the homeowner's insurance. And the combination of the two actually led to about a $2,500 shortage. And because of that, they chose to pay it back in about 6 months. And that was roughly about $400 a month. So let's now talk about your future in homeownership. So manufactured homes actually do retain their value just like any other property. And if you own your land, you've got even more value stored up. So when you're ready to upgrade your home, you can continue to build on that land, and you can really get creative, right? You know, I've had people that have come to me and they like the fact that they're buying that manufactured home. And when they get creative, they come up with different ideas, such as, let's just go ahead and build a couple alternative dwelling units, such as like teepees or A-frames, or turning their barn into that barndominium like my customer did, and making it a short-term rental. That's considered glamping nowadays. That's something that my kids had to teach me. Other things that you can do when you buy manufactured homes with a lot of land is you could actually cut out a piece specifically for campgrounds, right? So if you have amenities on the land, such as homesteading, like if you're raising animals, I mean, you could have like, petting farms, you can have a lot of different things, bring in that finances to kind of offset that monthly mortgage payment. You can also turn that excess land into storage. I'll tell you, recently I paid to park my boat at a storage facility, and it was over $120 a month for this storage facility. It was outside. Yes, there were cameras. However, the parking space is literally so tight and so short that my tongue is sticking out. The trailer tires are pretty much protruding to the point where it's hugging the lines. You can also use the property as wedding and retreat venues. There's a lot of things that you can do when you're buying these homes. Sharing the fruits of your labor not only has the potential to generate that short-term income, but can also create an enduring stream of revenue for years to come. Remember, a rising tide always raises all ships. Whether you're drawn to the affordability, the community, or the simplicity of a manufactured home, your dream of owning a home is definitely within reach. You know the best loans, how to apply, what to look for, and how to close on your first manufactured home. Now that you're armed with the right information, with some planning and support from an experienced team, you're ready to navigate the buying process confidently and make informed decisions that best suit your needs and budget. So what are you waiting for? Act now, because home ownership is within your reach. If you're still not sure or have more questions, there's going to be a link down below to get in touch with me and my team. We're ready to help. Experiences you'd like to share? Or maybe a topic you want us to cover next? Drop a comment down below. We'd love hearing from you and are here to support your journey every step of the way. Your questions might just be the inspiration to our next video, helping not only you, but many others navigating this exciting path. Remember, the key to unlocking your home buying success story is just a click away. Let's embark on this journey together into your future of homeownership. I'm David Zai, Mortgage Guy, and I'm out.